And now we're going to move into the last portion of our program today, and we're going to conclude with a panel discussion that's entitled Adapting and Preparing for Continued Volatility in Commodity Markets. And again, we encourage you to submit your questions for the panel in the Q&A box at the bottom of the screen. So it's my pleasure to introduce our moderator for the panel. Our moderator is OSU Extension Director David Marrison, and he's going to moderate today's panel. David's an associate professor, an agricultural and natural resources extension educator for OSU Extension located here in Coshocton County. He received his Bachelor of Science in Agricultural Education and Agricultural Economics in 1990 from Ohio State, and a master's degree in education from Purdue University in 1992. David's been an extension educator for OSU Extension since 1997, first in his home county of Ashtabula, where he grew up on a small dairy farm near near New Lyme, Ohio, and now in Coshocton County. He's currently the co-leader of OSU Extension's Ohio Ag Manager team. He's received 2 of the OSU Extension's highest honors when he received the 2007 Excellent in Extension Award and the 2015 Steve D. Rule Outstanding Agricultural and Natural Resources Educator Award. He also received the 2010 National Association of County Agricultural Agents Distinguished Service Award and was the 2017 Search for Excellence Award for Farm Management Education. So David, I'm going to hand over to you, and thanks very much for moderating the panel.
I appreciate it, Dr. Sheldon, and that's probably the longest moderator intro I've ever had, so thanks, Ian. And we have the pleasure of having 3 industry folks who are here to talk about adapting and preparing for continued volatility. It's a great topic, and it's my pleasure to introduce the 3. And so the format over the next 40 minutes, I'll introduce the 3 panelists that we have. We have some questions that we've given to our panelists, and we'll ask those. And of course, as Dr. Sheldon said, anytime you have questions, don't hesitate to drop those down in the Q&A box or the chat box, and we'll get to those. So first, I'd like to introduce to you Aaron Appel. Aaron currently trades soybeans and barge freight for Consolidated Barge and Grains Ohio Valley region located in Jeffersonville, Indiana. He's been in this role since 2018. Prior to 2018, Aaron worked at the corporate office in Mandeville, Louisiana with the rail department, where he managed the Western Soybean Rail Program and the Burlington Northern Santa Fe Shuttle Freight Program. He's been with the Consolidated Barge and Grain since graduating from The Ohio State University with a bachelor's degree in agribusiness and applied economics in the spring of 2011. And he grew up in a grain and hog farm in Northwest Ohio, and he enjoys spending his free time with his wife and 3 children. So Aaron, we welcome you to our panel. Next is Bailey Elchinger, and Bailey, I hope I said that right. Close enough for Jazz? You'll correct me. So she's an agribusiness management graduate of Michigan State University and currently a risk management consultant and regional director for StoneX Incorporated, located out of Bowling Green, Ohio. Bailey works with the grain and livestock producers throughout the Midwest and Ontario to help them manage the risks they face in the commodity futures markets. She says her goal is to empower producers with the grain market information and historical analysis required to make sound business decisions for their operation. And her ideal outcome is for producers who are in making their grain marketing decisions that they'll make them based on dollars and cents rather than ifs and buts. Bailey and her husband, Nick, and their 2 daughters, row crop and co-own a large hay and straw baling business in Northwest Ohio. So welcome, Bailey. And then finally is Erin FitzPatrick. Erin was born and raised on a farm in Western New York, where her family still owns. She has over 10 years of experience as an agri-commodity analyst, and she's currently the vice president an analyst of grains and oilseeds with Rabobank Research. And before joining Rabobank AgriFinance in St. Louis, she worked at Bunge, where she served as the director of economic research. In addition, Aaron worked for Rabobank between 2007 and 2013 in London and New York City. And she holds a bachelor's degree from the State University of New York at Buffalo. And in her spare time, she enjoys competing in triathlons and teaching skiing. So Aaron Bailey and Aaron, two different spellings even on Aaron's. We welcome you to our panelist panel discussion. And the first set of questions, I think we're going to open it up and ask it to all three of you in turn. And then we have some specific questions as well for each of you. So at this point of our Outlook meetings, most folks probably have become aware of major disruptions to agriculture, to the agriculture supply chains during the early stage of the coronavirus pandemic. And has been mentioned during the week, sometimes this was either rightfully or wrongly portrayed in the media. But regardless of how it was portrayed, in most cases, it was accurately outlined. They accurately outlined the underlying issue: the decreased driving, lowered fuel and ethanol use. We had worker safety concerns that slowed or shut down animal processing plants. And now we had to retool to repackage or transport products in forms that consumers could get it during the pandemic. So the question we would like to ask each of you is, now that the supply chains have settled at a new steady state, will we see long-term impacts in our commodity markets? So Aaron, I'm going to toss it your way first, and then we'll go to Bailey, and then back to Aaron.
Sure, I'll take it. So yeah, I'll talk about more from the impacts we've kind of seen on the grain handling side. Here, especially at CGB. To be honest, with the whole COVID-19 pandemic, we really haven't been impacted too much on the grain handling side. When it first hit us in the spring, when people started to shut down, there were some concerns. But since we were declared an essential business, people that like myself that work in the office, we just told those people to go home and work as best you can from there. But operationally, we try to run lean, so there was some concern, from the operations side. If somebody gets COVID, do we have to quarantine everybody and whatnot? So we've been able to manage through that, work through it without any interruptions to our customers or to our business. And actually, myself, I've been back at the office since early May. I'm in a different office today because we're remodeling our office here in Jeffersonville. We're going to space out the desks, and the crew came in today. We're going to actually make sure that right now it was every other desk was empty. We're going to just eliminate that space and make sure that we're maintaining our 6 feet here. So really haven't seen it from our side. In the barge freight side, which is a big component to us. We have facilities from Cincinnati. I manage our barge freight from Cincinnati all the way to Uniontown, Kentucky on the Ohio River. The barge carriers, I haven't heard any issues on any river segment in terms of them being able to move, being able to find crews to crew up boats or whatnot. That hasn't seemed to be a problem. The fleet seemed to be okay, no issues there. The trucking side, the one impact I saw was the fact that trucks became more readily available when the ethanol had its issue, and plants really idled back or cut back on production. That freed up a lot of truck freight for us. We were able to get some guys, maybe move some grain to some different places and get some trucks that we otherwise wouldn't have been able to. And then the only issue I've really seen is on the rail side. In particular, the CSX. We have 2 CSX shuttle loaders. In the past few years, they've really laid off a lot of staff. They've really cut back on the personnel expense side. And any hiccup when it comes to like COVID-19, that really hit them hard back in the spring, and they just could not move trains. They had so many people called off. They were just unable to move trains. We had one of our shuttle loaders over in Illinois plugged, and it didn't matter what we did. They just didn't have the crew to do it. And it got better this summer, train flows, but we're starting to see trains slow down again over the past 4 weeks. Their performance has gotten really bad again. My question has been, is it harvest activity? Is it harvest demand doing it as much as anything? And really the answer is no, it's just short crews. They just don't have people calling off because of COVID-19, and they can't move these trains. So that's where I've seen it impact. And how does that affect Ohio and the Ohio shippers? It worries you a little bit because all of a sudden now you got a facility in the middle of harvest that you're plugged and you can't take grain. That grain's got to go somewhere else, and that might back up a truck elevator that goes to that shuttle loader. Also from the destination side, I know back in April when it happened, there was a mill that almost ran out of corn. I think they ended up buying some trucks, truck corn really quick, very expensive truck corn, to make sure that that mill didn't run out while they're waiting on some trains to get there. You know, you want to kill all those birds down there. So I think it definitely worries both us as the shipper and definitely from the destination side when they need trains on a day-to-day basis. So that's where I've seen the concern on our side is, but for our day-to-day operations, we really haven't seen it.
Okay, so now we'll bounce to Bailey, and Bailey, I'll throw in there. Maybe you'll wouldn't mind talking about the ethanol component of that, especially long term, because we're seeing some an outlook that might not be as favorable because of lower gasoline consumption. So, what are your thoughts, Bailey?
Yeah, David, I think you hit the nail on the head in that, I think every day I hear of a new company that's gone completely remote that says, hey, we've learned how to function for 6 months without people in a brick and mortar building. So we're just going to stay that way. And I think you're going to some extent, see that continue. And when you look at the ethanol usage, ethanol blending into gasoline today, we've made a sharp return from the depths of the pandemic, but I'm very skeptical that we ever get to pre-pandemic levels. And then you toss on top of that just the sheer investment we're seeing in electric vehicles. One of the hindrances to ethanol really growing beyond the blend wall was the lack of investment in infrastructure, in pumps, in vehicles, in all of those different pieces that really push or would have pushed ethanol beyond the blend wall. Conversely, we're seeing that exact investment go into electric vehicles. GM, Ford, they're all opening new plants to make new vehicles. If we start to see them push into charging stations where there's a charging port at every gas station as well. I think you're seeing it from the Shells, the BPs, the Marathons, lowering some of their infrastructure investment into the oil industry. Kind of the writings on the wall of the industry sees this shift. And I think that's a real, I don't want to say fly in the ointment, canary in the coal mine, whatever, for the corn market, in my opinion. You've got something that uses 5 billion bushels of your production that it's not going away tomorrow. Don't get me wrong, but it's not growing at the pace we once grew at. And, it forced us to get really, really efficient and really good at growing corn. And that's not going away tomorrow. So I think that'll be really, really interesting to watch. Obviously, policy plays a part into that. I think you're going to have probably some policy depending on who's leading the country at a certain point in time. But if they're pro alternative energies, that may be kind of a short-term boost for the ethanol market, but that longer-term picture is more my concern.
Great, thanks, Bailey. And now over to Aaron. Aaron, we'll put the same question over what do we see long-term impacts, but especially when we look at the livestock, the shock that we've heard today on the livestock market, how's that going to impact grains moving forward?
Yeah, sure. I think, from the grain perspective, I think we've already done a good job of highlighting the fact that ethanol was really the biggest driver here. If you combine the two, the lower corn demand for ethanol, and then you put it next to the picture of the pretty good livestock feed demand that we've continued to see, kind of the biggest shock that we can look when we compare those two together is that there's a much smaller, or there's a reduction in the DDGs available as a byproduct of the smaller ethanol demand, and we're continuing to see strong feed demand. So those two factors combined have pushed prices for DDGs higher. I think they're trading at about 124% premium to corn, which is higher than normal. And then just the physical supply is not available. So that shifted stronger demand to soybean meal and corn. And so we've seen kind of a knock-on impact. Ben did a good job of showing the crush margins and crush demand earlier, but we're also seeing a knock-on demand as a result of the smaller DDGs to stronger soybean meal demand. And so the domestic market is demanding stronger soybean crush. At the same time, we're seeing this very strong export pull for soybeans from China. And so I think, when we think about it, how Bailey is describing it, where this is part of a longer term trend that's probably been exacerbated by COVID, This is longer term supportive of U.S. crush demand if we're going to have smaller DDGs available going into the market. Probably on corn a little bit to a lesser degree, but I think that is going to keep the market strong. If you look at also the export volumes that we're seeing, kind of putting it together with Aaron already said, the river is performing well, but we have these huge volumes of soybeans and corn that are being exported, and DDG exports so far this year have been relatively flat to down, and perhaps the competition for them will favor the domestic market in the short term here as soybeans and corn are preferred to be going down the river to export. But I think longer term it is supportive of meal demand and feed demand domestically, and that's kind of a focus that we've been looking at here as a knock-on impact of the fewer cars driving and the smaller corn demand for ethanol.
Great. So we're going to continue, and I have another question for all three of you. As in your business and from your perspective, what lessons did we learn from 2020 in price risk management that producers and agribusiness alike should consider as we move forward into 2021 and beyond? So Aaron, I'll start back up with you again, and then we'll go to Bailey and then back to Aaron with an E.
Yeah, sure. It's been an interesting year all around. You come into 2020 before you had the COVID thing, and it's still ongoing. And the focus was all on the trade war, and we were talking about big carryouts, big corn carryouts, big bean carryouts, and how much we're going to plant and whatnot. And boy, did that flip on a dime. It changed completely. We thought that China demand would remain slow given what they had with their swine flu problems over the past year, and they had a big appetite for Brazilian beans, and we thought once they flipped back over to the U.S., maybe they had covered quite a bit of that. But and just looking at the balance sheet numbers earlier on this year, a lot of the recommendations, and I think that they were right given what the balance sheets were showing to the producers was you need to get some of the stuff hedged. You need to be looking at locking in some, a lot of companies like CGB have these specialty contracts where you establish a floor and a ceiling, and you get an average price or something along those lines. And we're trying to get $9 beans for guys and $3.50 corn in market part of your crop there. Who would have thought that China would have came in the way they came in for the U.S. and just they've been at their pace of buying has been just crazy, especially on the bean side. Every day they're buying more and more and more. Record purchases on a daily purchase on a corn standpoint. Back in a couple months ago too into China, and not only did it take futures prices up and kind of make those contracts that had been recommended by grain companies and brokers look bad to those farmers that had put them on. It also, if you're sit there and you're trading spreads and you're looking at this balance sheet and you're like, man, I'm just getting killed on some of these spreads because it just doesn't make any sense. But this demand pace was just something that I think a lot of people in the industry didn't see coming, to be honest with you. And I guess from a selling side, because that's a lot of what I do, selling SIF beans into the export market and buying the freight. The best thing I could say is for what we did was we just kept selling into this thing. We had historically good basis levels in the summer for beans for this fall at the river, and actually I give our farmers credit. And I don't know if I was a merchandiser or just the farmers realizing that our prices were historically strong, but we had a really large book coming into this fall in terms of beans. Corn, not much. Corn guys were not laying off on. And I think it's been rewarded here in the last week or so. You've seen what river basis has done. We've went from, I wrote these down, we were paying, I believe, like 20 over for beans at Cincinnati on October 26th, and then we were paying 53 under for beans delivered Cincinnati. This is for fall shipment for Ocnove just the other day. And so I think guys that I think that people did the right thing in terms of marketing part of their grain, trying to get those $9 levels, but you also have to be cautious. You can't sell your entire crop. And So I think we both, I mean, the producer and the commercials have learned a lot from this. And one thing is when China wants to go and when China wants to do something, they can move the market, and they can move the market in a big way.
Right, and I guess that's expect the unexpected in 2020, right? That was the common theme for that. So Bailey asked the same question to you. What did we learn in price risk management that we can use and put in our toolbox going forward?
Yeah, I think Aaron hit on some great pieces. I guess to sum it up into a couple sentences, first and foremost, know your cost of production. And I'll talk more about that, I think, in some of the questions you've got scheduled for us later. But the quote I like to use is, prediction in unprecedented times is next to impossible. Don't focus on just selling at the high. Like if you looked at that this year, you're going to say, oh my gosh, I'm the worst grain marketer on the planet. But I always like to spin that question, right? Do you get to farm again next year? Because that's our goal, right? Our goal shouldn't just be, did I sell at the high? And most importantly, don't let this 1 year of abnormalities throw off a really well thought out plan that's right 80+% of the time. So I don't know, it stinks, right? We all sold it ahead of time per my advice, per various analyst advice. You should lock some of this in. These are good levels, are profitable levels. You know, demand is sluggish. We're going to have a 3 billion bushel corn carry out. You better sell some. I mean, we farm at home, right? My husband had corn sold for like 320. So trust me, I get the burn. I get the feeling, right? But we can't let that throw off a really well thought out plan that works 80% of the time.
I was trying to write those quotes down. Prediction in unprecedented times. Say that again, Bailey.
Prediction in unprecedented times is next to impossible.
Next to impossible. I think that is a quote we could put on our backdrop right behind us, right? So thank you, Bailey. And I would move over to Aaron. Aaron, same question. What can we learn? What can we take away from 2020 that we're going to use in price risk management going forward?
Yeah, sure. I mean, first, I guess I'll echo what Bailey said, because I spend a lot of time out in the field talking to farmers too, and this only kind of solidifies some of their opinion that maybe we should wait and pick the highs, which is not something that we ever want to recommend. But I think, just another way I think about it is, what happened this year only shows us how much more each year our markets and our fields here are becoming much more interconnected globally, where, we're not harvesting a very bad corn crop or very bad soybean crop. Sure, the estimates have come down from earlier this year, but it really goes to show you how big some of these swings can happen when it's being driven not only by this big demand from China, but the fact that South America had really sold out most of their crops and their supplies before the demand started shifting to the US. And we had some supply issues and shorter crops than expected in the Black Sea region. And then also, not only just on the total supply side and the demand globally, but the logistics side of it. We can talk about what COVID made due to the logistics here in the US, but it's also can shut down ports and logistics in Brazil, Argentina, and China. And that's going to impact what we're seeing here in the US. And so, I think it's just another good reminder that we can't just look at, what's USDA saying about, Iowa's corn yields. We really also have to keep abreast of what's going on with the domestic market in South America, what's going on with global freight markets and logistics, and what is going on with China, because, they are still ultimately a very important buyer of our crops. And it just, I think it highlights to me how interconnected we really are globally in our markets. And we need to always keep that in mind when we're thinking about our marketing plans and risk management.
Aaron, as you're talking there, I'm thinking about, we become perfect to talk about the globalization. It's just not what happens in the I states. And definitely our producers benefited in some strong ag exports. But when you talk about global, when you're talking about a research firm like yours and you're doing long-term market outlooks, you're trying to take a look ahead. Let me throw a couple other factors in there just to get your reaction to it. How do you, as you put your marketing research together and outlooks, how do you because I think these are going to be some words we're going to hear, right? Climate change. How do you work that into your forecast? And then secondly, how do you look at the policy changes? Maybe some changes are happening within policies in other countries around the globe and how that all impacts your price analysis.
Yeah, sure. So, I mean, that's something that we talk about quite a bit in our organization. I guess, first of all, from a policy perspective, we're not an organization that's, has a lobbying group or any particular interest one way or another in DC, for instance. And also as an analyst, there's no real way to, analyze policy per se, but we certainly need to be aware of what policy looks like around the world, because as a lender, we're exposed to risk all the way along the value chain. It's not just a corn soybean farmer in the Midwest, it's farmers throughout the globe. It's grain handling companies throughout the globe. It's consumer facing companies throughout the globe. And there is a big trend that's happening within the industry, which might not be completely driven by policy, of connecting farmers to consumers. A lot of the grain handling and also even meat companies are shifting more towards having a sustainability type of approach to how they are doing their business. And then also within our bank internally, we have a team of sustainability, a sustainability team. And so we look at it from both our internal risk perspective, but also in terms of the business. And the business is demanding more and more focus on sustainability. From the farm gate level, I think what that means to us is that we need to be very good at telling our story as from the farm gate level, of helping consumers, helping our partners in the industry understand that most US farmers are actually already doing a lot of the things that check the boxes of being considered sustainable, because you really can't be an efficient producer, efficient operator in the US and be unsustainable longer term. So a lot of it is analyzing the risk for us as a bank globally, but I think a lot of it too, at least from my perspective as an analyst in the US, is helping to tell the story of what US producers are already doing and what are some of the things that they're working on to be sustainable, and how do we share that message within our organization and then also globally to our bank and to other customers who are buying from us.
Great, thanks, Aaron. So now I'm going to bounce back to Aaron with an A. That's how I'm going to keep you apart, A and E. That's how I can remember. On day 3 of the Outlook conference, they talked a lot about trade. And of course, where you work with Consolidated Barge and Grains in the position as far as grain transportation, what growing issues might we need to keep our eyes on as producers in agribusiness when it comes to the infrastructure and the ability to move grain throughout our country?
Yeah, there's definitely some big infrastructure issues that we are facing, and then they're mainly issues that you don't hear about, or mainstream media. Big media is not going to cover them. It's issues that, for the most part, go under the radar, and it's really our river system and our lock and dam system. It's aged quite a bit. I mean, some of the locks are over 100 years old. There is a big project that was done this year on the Illinois River, where they did a complete closure of the Illinois River locks. I'm trying to pull it up here on my screen. They closed the Grange at mile 80 on the Illinois, so everything 80 and north up to Chicago was closed from July all the way up to September 30th. And the fear was, given the Coast Guard or giving the Corps of Engineers what they get done in time, they did a pretty good job. It ended up being delayed 2 weeks, and they ended up getting done mid-October. But in the notes, what I read here is like, reason for these repairs: dewatering lock chamber to repair crumbling concrete and steel structures. So that's the issue we have with these locks. I mean, they're old, they're crumbling, and the issue why they're not getting fixed is because the lack of funding is a big part of it. And I don't know, it's not like the river industry and the grain industry and everybody that's using this river system has tons and tons of money. They'll go lobby in Congress to get more money directed towards these lock and dams. But it's a very important part of our river system. The river system is by far the reason that the United States is the exporting powerhouse it is when it comes to grains and a lot of other things. I wrote some numbers down. I'll give you an example. December barge freight right now on the Illinois River, which was shut down. Let's use Utica, is 450% of its rate base today, which is $5.07 a ton. Over here at Cincinnati, December is 375% for December, or December's 375%. Breaking that down to cents per bushel, like from going from Utica, Illinois to the Center Gulf, that is 64 cents a bushel for corn, 68 cents per bushel on beans. That's it. From Cincinnati to move that corn from Cincy all the way to NOLA, it's 49 cents per bushel for corn and 53 cents for beans. And that is 1,293 river miles from Cincinnati to, I use Convent, Louisiana, which is our parent company, Zeno. That's their export elevator. And on the Illinois, that's 1,181 miles. If you use, let's use Cincinnati again for corn, 49 cents per bushel is what it costs to move December corn from Cincy to the Gulf. That'd be the same as if you had to truck it, moving corn down I-75. That gets you from Wapakoneta down to Cincinnati, Ohio, using $2 a running mile and deadhead freight. So that tells you the difference and how cheap it is to move commodities on the river system and how important it is to make sure we maintain our lock and dam system on the Ohio and on all river segments. One thing that's happened on the Ohio is the mill price lock and dam finally finished 2 years ago, back in 2018. It was a project that was started in the 90s. It took them over 20 years to do. It replaced two locks, Lock 52 and Lock 53. And fortunately for me, I was down in Mandeville when Lock 52 was still operational, so I didn't have to deal with the logistical headaches. But there towards the end, that lock was awful. There was complete closures on the Ohio River for weeks on end. And what would happen is you would have, crazy prices, basis levels for Ohio shippers would get really cheap because all of a sudden your barge freight, anything that was above that closure, you're paying through the teeth to buy it, and any other commodities that had to come through had to be rerouted. So it becomes very expensive when you got to figure out how to stop a barge of whatever it is and offload it onto a truck or offload it onto a train and get it to where it needs to be. So the infrastructure issue is definitely a big concern moving forward. We have to continue to find money, use taxpayer dollars. I don't know how much money is going to be in that HEROES Act that the Democrats are proposing to go to the lock and dam system. I would guess probably not very much, but if you're going to spend 3.4 trillion, why not allocate a portion of that to our lock and dam system? But I don't know the numbers, to be honest with you. But anyway, it's a big concern moving forward. If we want to stay competitive in the world market, we're going to have to maintain our lock and dam system.
Aaron, one thing I appreciate is you just put those in terms that every farmer in Ohio can understand, as far as the 50 cents. And just the way that we in the industry, whether we're in agribusiness or we're farmers, that we should be advocating, and we need to advocate even more to our legislatures to look at the lock system. So spot on. I appreciate how you did that. So Bailey, now let's look at Northwest Ohio. We know the animal agriculture of the past few years has grown over the last decade up in Northwest Ohio. So as we're looking at this more at a local level, but also global level, the demand, of course, is changing. What are things that the U.S. can do to help increase our competitiveness in the international market with all these factors together?
Yeah, and I think this is kind of an interesting question. I think even if you just look at the last, 15 to 20 years and the importance of the Southeast feed market, for example, to all of Ohio and namely Northwest Ohio, the infrastructure that's been built and grown in Ohio to very quickly and efficiently ship on a rail line to the Southeast feed market that's either going to get made into soybean meal or corn used for feed in the chicken and hog houses down there, or put directly on a vessel and shipped out of Wilmington. I think that's been a game changer for Northwest Ohio. You add in there all the actual livestock growth here locally. Pigs got to eat every day. Chickens got to eat every day. So that's continued to grow the year-round demand that we've got for corn. And also help stabilize the basis levels that we see. it allows us to have a continuous use of corn throughout the year without having to necessarily put it on a barge. Although I do love Aaron's analogy there, so good work. But yeah, without having to put it on a barge, having the local and domestic feed market has helped alleviate a little bit of our reliance on the river system, but certainly still a very key part of our competitiveness in the world. Rail logistics become key to that as well, and our competitiveness of getting our product to the end user is really important too.
Great, thanks, Bailey. And now, Aaron, with an E, we're going to come back to you. We are, of course, we're pushing that home stretch and harvest here. And usually at this time, that's when we start flipping our sights to what's happening down in South America. And of course, that then starts to drive some of our markets. So we're at the beginning of this stage. What's your team expecting out of South America for the upcoming crop? And I might have a couple follow-up questions to bounce in there to you too. Yep,
sure. So the crop in South America, I guess looking at it from kind of start to where we are today, if we consider how the prices and you do the calculations for cost of production there. So for instance, a Brazilian farmer, we estimate about 70% of their costs is indexed to the US dollar and about 30% of it is indexed to the Brazilian real, whereas 100% of their commodity or their crop costs is indexed to the US dollar. So already the Brazilian farmer has an advantage in terms of a weaker currency, allowing their production costs to be relatively lower than US producers. So we were already heading into the season with relatively strong profit margins for South American producers, which has continued to encourage, at least in Brazil, an expansion of acres or area planted. And that's what we're seeing again this year. We do have a little bit lower area planted forecast than USDA does for Brazil, but we're looking at corn in Brazil being a 107.4 million ton crop, soy being at 131.4. Both of those are up about 5 million tons year on year in terms of production. In Argentina, we're expecting a little bit of a shift from acres from corn to soybeans, mostly because of politics there. But still, we're looking at the soy crop potentially being up 2.5 million tons to 51.5, and then Argentina with about a 50 million ton corn crop. I will say that right now we're using trend yields because it's still early in the season, but plantings have been delayed. We saw the very brown weather map that Ben showed us earlier today of how dry it's been in mostly southern Brazil and Argentina. And this weather pattern typically maintains in South America. The longer range forecast today is for drier than normal weather from now until January. So I would say that right now I would be biased that we're going to have smaller crops than the numbers that I just projected to you, but it is still relatively early. And so I think, it's kind of prudent to use trend yields. In terms of the planting pace, they have been delayed. Soybean planting in Brazil has caught up to close to normal right now, but the early area that's typically planted was pretty delayed. And so we're starting to see some change in the second crop plantings decisions for farmers in Brazil. So there's probably been some shift away from safrinha cotton and into safrinha corn. But then the later planted safrinha is going to be dependent on how we can get these first planted crops in the ground in Brazil. But overall, we are looking at the potential for higher output in South America because profitability encouraged it. But I think there's a real big weather risk going forward, and there's probably some downside if we don't start to see a big change in the weather pattern.
Great. And one thing our producers always talk about is the land that gets put into production. How much more can Brazil put into production, new land into production in the next, say, 3 to 5 years?
Sure. So we estimate that there's about 20 to 30 million hectares of pasture land in Brazil. And typically when you're bringing new land into crop production, that's where it's coming from. If you look at some of the recent trends, so for instance, the profitability in the last couple of years, we can see that about 1 to 1.5 million hectares per year will come online from that pasture land being converted into cropland. So, in 3 to 5 years, I would say, 3 to 5 million hectares additional we could see being planted to grow crops in Brazil. And, I think we also have to remember that 1 hectare in Brazil isn't just corn, isn't just beans. They plant first crop soybeans, harvest, and then plant a second crop corn. So, 1 hectare is, in many cases, the equivalent of 2 hectares because they'll grow a soybean and a corn crop on that acre or hectare.
Now, Aaron, you mentioned, and this is a question I'd like to ask you, but also bounce it to our other two panelists. You mentioned something about currency and exchange rates. So I guess my question would be is, as you look at exchange rates, they've fluctuated a lot, especially during this pandemic that we've been in. But how do each of you, so Aaron, we'll start with you with an E, how do you use those exchange rates in your daily work?
So, I mean, we do also have a research team here who looks at currencies. So fortunate that I don't have to do too much of the analysis myself. But when we are looking at, for example, what's going on in South America, and then also, doing our price forecasting and global demand forecasting, the consuming countries that are importing our commodities are also having risk, currency risk. And as the dollar strengthens and their currency weakens, there's going to be lower import demand for a lot of these commodities. We do a lot of scenarios where we will compare, not only what flat price would be, but what different currency levels would be for particularly South American producers to come up with where we kind of see the production outlook going forward. And then also, when we're looking at it from a banking perspective, where our risk is, and where we're lending money and comparing it to a producer in the US versus South America. But I think, probably the biggest one that I use on my day-to-day is just kind of the original example I gave and looking at the profitability and production outlook for South American producers versus a US producer.
Great. Now, that's the same to you, Bailey. How do you incorporate that, the exchange rates?
So actually, a large percentage of the customers that I work with every day are in Ontario, who face similar challenges to those in Brazil, right? They're selling a product in Canadian dollars, and they're hedging it on a U.S. exchange. So I actually work with exchange rates and trade FX every day. But Ontario, love the folks I know there. Not quite as a global of a player as Brazil or Argentina when it comes to, watching what currency is doing. So in addition to watching the Canadian dollar, obviously watching those other currencies and what that means for their producers, I think one that we've seen have a really big impact in the corn and soybean markets is the Argentine peso. Recently, it completely falling out of bed. As Aaron mentioned, that affects the profitability of those producers, but also some policy going on in Argentina that Argentine farmers, couldn't hold U.S. dollars. So instead of, or they can only hold like 200, the equivalent of 200 U.S. dollars. So rather than selling their beans and getting money, they would just hold on to their beans as a hedge against inflation. So that meant Argentine crushers would have to pay more to get the beans out of the farmers' hands. As they had to pay more, that reduced their competitiveness in the world soybean meal market. And as Ben mentioned earlier, Argentina is such a player in the meal market as opposed to really the whole bean market. So really creates kind of an interesting piece to watch. And I think Aaron mentioned this earlier, that it's so much more involved than just what happens in Iowa and Illinois today. And now we worry about whether an Argentine farmer wants to buy, a new house and has to sell beans so they can buy a house, and not just whether it rained in Northwest Iowa. So I think just really an interesting relationship that we see in the world today. But political and economic uncertainty, whether it's Brazil, Argentina, Mexico, China, are all going to have huge impacts on the commodity markets.
Great. And Aaron, how does Consolidated look at when it comes to exchange rates? Of course, you're shipping some grain. So how do you deal with it?
I mean, of the three of us on here, I'd probably deal with exchange rates the least. Very little, really. I pay attention to them. In my job, I'm not trading them. Our export desk down in Mandeville, they have a team, or they have a guy that does. I just pay attention to direction. That kind of signals to me, am I positioned correctly, how I want to be. If the dollar wants to move lower, then obviously that's going to be supportive to exports out of the U.S. and vice versa. I will say though that the one guy I sit next to in the office, we're partnered up with a company called Brooks Grain, and we import a couple vessels of rye every year. Brooks does, and all that rye gets made into bourbon. So he's actually involved in trading the euro. So it's pretty interesting to listen to him talk. He's the guy I turn to if I have any currency questions. He's trading it. But so I guess in terms of in our office, the guy that's buying the rye to be made into your bourbon, he's the guy that's really paying attention to it when it comes to the euro and the dollar. But for the most part, I just try to pay attention to the direction and also what the real and the South American countries, what China's doing as well. But I'm not the expert when it comes to foreign exchanges.
Okay, great. So we're in the home stretch here. Just I'm going to throw one question out there at the end, but I want you to notice that there was two questions that came through the Q&A just for the panels. You can choose to answer one of these questions or answer the question I'm going to ask you. The questions we got was someone finds it interesting that industry strategists speak to a shift in artificial intelligence machine learning as a way to take full advantage of trends. Countries like China have embraced the data analytics mantra as the foundation for their decision making. And then what could this impact be in the crop marketing business? So maybe if you want to look at that one, or this question, as folks in the business, what keeps you awake at night? What keeps you sleeping with one eye open? Or what advice do you have for our farmers and agribusiness that if it's one thing, I have 30 seconds left and I need to get it out there for them to hear, what is that? So I think, Bailey, I'll start with you. Oh, look at you were waiting for me to call on an Aaron, weren't you?
Right off the top of my head, and it's probably because of one of the questions you had prepped for us about, there's so much in the market today to pay attention to. That's probably what keeps me up at night. My job is to give sound analytical advice to people based on what I see and what I understand the markets to do and what I think they're going to do. That's a little challenging today because it's not just, is it going to rain in Iowa? It's what's politics tell me, what are relationships doing, globally, all these pieces that, gosh, now you're trying to predict human behavior, and that's extremely difficult. But I guess my biggest piece of advice is continue to learn. Read as many articles as you can. Try and read those that contradict your bias. Like if you're a producer and you just assume the market has to go up, find that person that tells you it's not going to and why. And try to understand where they're coming from to really round out your opinion of what you're looking at. So that's my quick piece of advice is find somebody that you trust that maybe opens or expands your view of the grain markets and really take that advice to heart. Great words.
Okay, Aaron with an A.
What keeps me up at night? Barge freight. By far, barge freight. We've been almost plugging the last week and a half. It's been crazy. And then we look at our book for December through March. We're going to be going crazy. Export demand's massive. And it'll be barge freight, barge freight, barge freight. And that's my job to make sure our facilities don't run out. We're looking at capacity, what our facilities need. We cannot afford to miss a day where there's no barge under the spout come December. So barge freight keeps me up at night. It does. I think about barges way too much. It's kind of weird, but it's barge freight.
Okay. And Aaron with an E.
Sure. I guess nobody's talked about the data analytics question, so I'll quickly answer that one. Yes, I do. That's a major trend. My company has recently created a data analytics team. I don't know any of the major, corporates in our industry that doesn't have some type of a team that they're either building in-house or sourcing somewhere externally. In the previous team I worked at, I had a bunch of junior analysts working for me, and they said, I'm really concerned, like, what is this going to mean for my job? Are they going to need us as analysts anymore? And regardless of how we're looking at it, there's not enough artificial intelligence or data analytics out there that can be assessed without having people that know the material. I think there's actually now more difficulty in finding people who understand data analytics and then can actually go out and say, oh, I stay awake at night because I understand what's going on in the barge freight market. It's hard to put those two pieces together. And so I do think that the capabilities and the data analytics that out there is a very strong tool, and it's going to continue to grow, but it's a tool that cannot be used without people who understand the actual business that we're in and can make use of the data analytics that's out there. And I hope that helped answer that question a little bit. Just to answer the second question too, because this is a space that I've been kind of focused on here in the last few months of this year, is beyond what not necessarily keeps me up at night, but what is an advice or a topic or a thought piece that I would want to leave with producers is an emerging trend that I think we're seeing from consumers is a focus on their perception of health and wellness, sustainability, and we're seeing the industry shift towards providing a lot of those products to the end consumers. If you look at some of the big grain handling, grain processing companies, they're focused on ingredients, they're focused on functional foods, they're focused on plant-based meat substitute products. And a lot of these things, I mean, they're not huge markets, but they are opportunities for farmers to perhaps diversify into some other crops or connect with their buyers or their consumers in different ways, and offering some smaller niche markets, which may not have been there 5 or 10 years ago.
Great. I think, Dr. Sheldon, before I pass it back to you to close us up for this great Outlook meeting, I think a thing that would be fascinating for me to watch is see Aaron, Bailey, and Ben Brown in a room and just sit in the back and watch you four speak and talk to each other. I think that would just be amazing to watch your young, brilliant minds together, the four of you in a room together. So we appreciate what you're doing for the industry of agriculture and taking time out of your busy schedules to come on to the AEDE Ag Outlook meeting. I just thoroughly enjoyed having some discussion on some of the topics that we talked about. So thank you, Aaron, Bailey, and Aaron.